I'm John Hanna for CDTV.net in New York, and we have Lee Hull at Dallas, Texas right now. Good afternoon, Lee.
How you doing?
Great, great, great. Now, Lee, tell us about your background.
Sure. I started in the financial services industry, probably like a lot of people did at a major brokerage firm. It was in Merrill Lynch that I started at in the mid 1990s. And then in 1999, I started my own company, Hull Capital Management, to manage alternative investment strategies for retirement plans as our specialty. Uh, and needless to say, I didn't know when I started in 1999 I was walking into one of the worst 10 years in history. But anyway, that's how we started.
Well, there you go. We're still in the financial. Well, it's still a crisis of sorts right now. But let's go into your book. Tell us about your book.
Less Risk, More Return is the name of the book, and I wrote this book after basically being encouraged by one of my clients, who's a financial writer, to write it. And he urged me to write it because he felt like this kind of book didn't exist for people like him. He was a guy who knew all about Wall Street and a little bit about investing, but still wasn't getting the results he wanted it. And he thought my approach was a great way to go for people who control their own retirement plan. And in today's world, we're all pension plan managers or retirement plan managers, 401ks, IRAs. We all pretty much, unless you're a government employee, we're in charge of our own retirement plans. So the book is geared to educating investors on how to get the best out of both traditional investments and alternative investments so they can be a better manager of their retirement plan.
Okay, so when you define that your target audience, which is your friend there, what was he looking for? What kind of returns was he looking for?
Well, it wasn't so much an exact return and that he was looking for. Is that if you think about it, most traditional investment portfolios or traditional asset allocation plans aren't really in sync with our real investment goals. For example, nobody says, I only want to retire in 20 years if the market does 10% or more. People want to retire on time and with enough money no matter what happens to the stock or bond market.
Right.
But traditional portfolios are set up, they make money when the market does good and they lose money when the market does bad. That doesn't really help them hit their real goal. Their real goal is to get ahead no matter what happens. And our goal is in absolute returns, trying to get ahead no matter what happens as well. And if you look at the ultra-rich, according to the Institute for Private Investors, the ultra-rich people having, I think it's defined as 10 million or more, have 42% of their assets in alternative investment strategies. Yale and Harvard and Balance have over 50% in alternative strategies. So when you look around, his comment was, how the ultra-rich do it and the ultra-wealthy do it is completely different to the advice given to the everyday investor. It's completely different.
Okay, let's define first the ultra rich.
I want to say, I have to go back and look at it, I want to say it's 10 million or above
Okay.
in investable assets.
Okay. Now, when they have someone like that, what kind of alternative assets are they looking for? Like what area are they going into?
Well, what you typically see if you look at, let's take Harvard and Yale, which have public disclosure, so you know a little bit more about them. They're going to hedge funds, commodity advisors, and private equity. And they're also coming on that with direct ownership in real estate, basically. The Institute for Private Investors is not as good a breakdown because it's not, they're private investors. They don't have to disclose publicly. Basically, what you're looking at is, they're using alternative investment managers to manage private equity or commodities or hedge funds, market neutral strategies that the average investor does not have access to.
And what else do you have on your book that you're talking about with regards to less risk and more return?
Well, what I went through in the book starts out explaining, what the big risk is for all of us, which is a prolonged period of low returns in the stock market like we're experiencing now. Then we talk about how traditional investment advice handles that and how alternative investment advice handles that. And then we look at, a sample alternative strategy because most people are intimidated or don't understand when you use the word alternative investment strategy what that really means. And for the book's purpose, it's those returns which do not track the market or are not correlated with the stock market. And it's set up in a way that you can do this inside your IRA or your retirement plan. We also have a chapter on the role of a fiduciary advisor. If you want to hire a financial advisor, what should you pay? What kind of questions should you ask? What does a good portfolio look like? From that point of view, and basically a modern IRA is the term we use in the book, has a much higher percentage of alternative assets that kind of mirror the ultra high net worth crowd than a traditional investor, which has zero exposure to those assets. And the goal is to build a portfolio that grows in both good markets and bads, because that is our real goal, is to get ahead no matter what happens. So the goal of the book is for you to pick up the book, read it, come out with a blueprint, an action plan, so that your portfolio can really match your real goal of getting ahead in both good and bad markets.
Okay, so let's say an investor would have, let's look at the ultra rich, $10 million. So $10 million. How would you break that up with regards to your investment style within the book?
Well, let's back up one second. It would depend on obviously their risk tolerance and their goals and all those other issues. I think what we need to look at is break it maybe in bigger pieces. If you look at traditional asset allocation as it's practiced on a retail level, everyday investors, basically money is split between stocks and bonds. If you look at a balanced fund, or maybe have a 60-40 mix of stocks and bonds, that's the average investor's portfolio. If you look at the ultra rich, you're talking about maybe a third to 50% in alternative investments, maybe 10 or 20% in stock index investments, and the other in bonds for an ultra high net worth crowd. They're more concerned with retaining their principal in most cases than they are with making money. They're going to lean more conservative. But let's take a person who's, say, 40 years old, and they've accumulated some wealth in their retirement plan, and they've got 20, 25 years to retirement. How do they want to be invested? They want to make sure that they make money that whole 20-year period and don't spend, say, 10 years going nowhere like we have recently. And they might end up with a portfolio that's, say, 50% alternative investments, 20 or 30% index funds, then maybe another 20% bonds. And so the bonds and the alternative investments help offset the risk in the market. But the index funds would offset the risk of the alternative investments having a bad year when the stock market goes up. That way they get some of those gains no matter what. And those kind of portfolios tend to work rain or shine because no one investment is big enough that it can drive the whole performance. So in that scenario, you've got 50% in stock index funds and, say, bonds, and 50% in alternative investments. If the alternative investment turns in a 0% year, hopefully the stocks and bonds will do good that year, and vice versa. So, again, you don't want to put so much in any one area that one market can take you down. If the market experiences a bad, say, 10-year period, you don't want it to bring your portfolio to a halt. That's the main goal.
How are you trading nowadays in today's market?
We haven't changed anything, except we've reduced our volatility some the last several weeks. A typical day for us is we're looking at stocks and ETFs that have been sold heavily the last several days, and then we're placing orders way below the market. So if the market falls dramatically that day, then we'll want to buy in. We're trying to buy in during, I guess I call them mini panics. And we're never fully invested unless things are really, really bad. If the market's falling thousands of points, that's when we're buying in. If the market's going up dramatically, we're typically in cash by then. And the goal is, the retail investment advisor for years, the number one thing investors do wrong is obviously sell at the bottom and buy at the top.
Right.
And that's very well documented. And part of our strategy is to correct that problem. We're not saying we're buying at the bottom. We'll never buy at the exact low. That never happens. So at the exact top. But we're doing the exact opposite of investor behavior on a daily basis. We're buying in only when things are really bad on a public perception, and selling when things look good is the basic strategy for us. And we're putting in anywhere from no orders on some days. If the market's been up for several days, we'll typically place no orders in the morning. We may place 100 orders for things to buy in the morning when the market's been really bad the last several days.
Well, tell us about your company there.
We're a niche money manager. We specialize in managing retirement plans, absolute return strategies for retirement plans. And we, have taken concepts that were typically only available to the ultra-rich or hedge funds that we can do now through reduced costs and commissions and technology in everyday IRAs and provide that kind of diversification for everybody now. And that's been our specialty. We don't do the traditional financial advisor role. We're, as a money manager, we're providing those non-correlated returns for everyday investors inside their retirement plans.
And where can people find you? What's the website?
The book website is lessriskmorereturn.com, and our company website is hullcapital.com. It's HULLCAPITAL.com.
Awesome.
And the book will be for sale October 1st on Amazon, Barnes & Nobles, all those typical sites.
Awesome. And again, that's Lee Hull joining us from Dallas, Texas. And I'm John Hanna for CityTV.net in New York.